All right, folks, here we go again. Tim Davis coming to you guys with another market review. And it is really, really early, folks. Could not sleep. And every time I can't sleep, I always come and take a look at futures to see what markets are doing. And so far this week, there's been a lot of volatility. The markets are just all over the place. And that's just what happens in the bear market. But I'm going to point out something here um, that could suggest that we are about to have the next mega leg lower. And something you need to pay attention to and be mindful of. So we're going to start this by, oh, by the way, today is now July the 6th, 2022. Time is now 1:27 a.m. on the East Coast. I want to start this by showing you guys what we have in store as far as the Fed news release. So here, I was able to look and research and find the Fed's minute release and the actual conference, the actual days of the conference. Normally it's like 2 days. It's normally a Tuesday and a Wednesday. I want to highlight and point out to you guys, specifically focus on this release where it says April 6th, and it's next release where it says May 25th. And just to put a bug in you guys' ears, the next Fed minutes release, and this is the minutes release, they normally release the minutes right after, normally 3 weeks after a previous conference, and normally a couple weeks prior to the next conference. And the next, the last press conference was on June the 15th. As you can see, June 15th was the last press conference. Normally 3 weeks later, they'll have the next minutes release. Now, I point that out to show you guys that for the past couple, every time there's been a minutes release, there's normally a lot of volatility around that minutes release prior to, the day of, and after, and days after. And I'm going to show you guys. We're going to take a look at April 6th minutes release. We're going to take a look at May 25th, right around that time frame. We're going to look at see what happened within the market. So take a look at April 6th. So this is a look at and the futures market tells it all. Let's look at the S&P E-minis futures. So if we look, go back here, and I'm going to try to highlight the areas that we're going to focus on. So we go back here. April 6th is right around here. Yeah, April, so right around here. I like this whole area right here. So this is between April 5th and April 6th. One thing I'm gonna point out, markets were already prior to that, were already at its almost peak. In other words, back up to the top of the channel, just around that 50-day moving average. So we were already pretty much at a level where the market just needed a catalyst, you know what I'm saying, to tread lower. So around April 6th was right here, where I got highlighted, and look what happens after April 6th. We never did go any higher, but a few days, probably about a week, April 6th, about a week or two later, about a week later. And actually you see right after that, not even a week or two later, right after that, the markets became, started to become a little weak. You could look down below and see the full stochastics. How it started trending lower. It was started trending lower. That was a precursor of a next leg lower. Market started trending lower. As you can see down here in RSI started trending lower, and then eventually, right around April 22nd, it gave up the ghost, and we just came straight down. Straight down. And then the next minutes release, market came straight down right below the 50-day moving average, and that was a big significant move, believe it or not. And after that, markets really couldn't find its footing after that. And then the next minutes release, it's April 6th. Next one was May the 25th. So right at April 6th, you see we sold off. Back up to the 50-day moving average, sold off again. Couldn't even get back up to the 50. So right after April 6th, you can see since April 6th, it was just a straight sell-off all the way down, almost back down to the bottom of the channel. And then right about 5 days before the next minutes release, look what happened around May the 20th. Markets rallied. Around May the 20th, markets rallied. Then again, look at that. The next release is on May the 25th, which is right around here. Oops. So right around here. And this area, May 25th is right here. We rallied back up to the 50-day moving average. And then look what happened. The same scenario. Price action got stopped right at the 50-day. Didn't go any higher. It started setting up for the next leg down. We stayed right below the 50-day. Then we got, about a week later, look what happened. Boom, big decline. And now, as you can see, this 50-day has become an extremely strong level of resistance, folks. And look what happened, back down to the bottom of the channel. Now, look at this. Around June the 17th, price action, we're gonna stop by the bottom of the channel. And then we started to rally. Back up since June the 17th, rallied back up to the 50-day. I'm sorry, the 20-day. And then look what's happening. We pretty much got muted by the 20-day. We're still sticking around. In the past couple of days, you see a lot of volatility, prices up, prices down, but we ain't really going nowhere. We're just treading water right below the 20-day moving average and right below the 50-day. Now, guess what's coming up on today? And here we are at July 5th. Now look at July 6th, which is today, right before the Fed meeting, which is coming up. The Fed minutes release, which is coming up later today at 2 p.m. Now, one or two scenarios can happen today, but I can almost guarantee you we're not going to see no huge big market rally. We could see a rally back up to the 50-day moving average. So that's what I'll be paying close attention to today. As you can see, the past couple of days, as price has been trying to gain their footing, and this S&P managed to see volume has been picking up. So that's good for the bulls temporarily. But anything is possible in a day. We could, stop right here and travel back down to the bottom of the channel, or we can rally right here. I'm not going to sit up here and guess and tell you what's going to happen. All I can do is tell you that there's going to be a lot of volatility over the next day or so due to the Fed minute release. Now, we are still in a bear market. So with that said, more than likely, we're going to hit a level of resistance between where we are now and between this 50-day and get muted and come right back down eventually, just like we did the last couple of times after the Fed minutes release. So I wanted to point that out. And if you look at the oscillators, they're giving conflicting signals. Look at the full stochastics. It's still trying to head up. Wins percentage, it's trying to curl over. RSI is trying to curl over. TTM squeeze showing that the momentum to the downside is weakening, and likely we could see another bounce. We have to see. But I can almost assure you that 50-day moving average, regardless of what happens after sometime today, that 50-day moving average is going to act as an extremely strong level of resistance as it has been doing for the past several months. So needless to say, if we do get a quick rally today, sometime today or this week, I think the 50-day moving average is going to stop the rally in its tracks. It's going to confuse a lot of folks, and a big sell-off could happen right after that. So that's something to pay close attention to. And if I was even switched to the Dow Jones futures, you would see the same type of scenario. And the Dow just looks a little weaker. And the reason why the Dow looks a little weaker is because a lot of energy stocks that are within the Dow. Dow's having a problem, having a real strong problem getting back above this 20-day moving average. So keep that in mind. And if we do get a rally, that could be a significant rally in the Dow, but it will be quickly reversed, I believe, because I think the 50 days on act as a strong level of resistance. So keep this in mind. If we do get a bounce today, Dow is going to confuse a lot of people, because it could, between this 20-day and this 50-day moving average on a daily right now in the futures, that's about a good 800-900 points. but it's going to trap folks because folks will end up, if we do get that rally, if we hit that ceiling, and then we could see an immediate reversal in price action and drop below this level of resistance. So level of support. So you got to be careful and mindful and have some dry powder ready to take advantage of whatever the markets may bring us today. So today's going to be very interesting. So that's why I'll be paying attention to see how this volatility setups. Now, if we take a look at VIX futures. Here's VIX futures. One reason it gives me pause to believe that today could be not so great, or this week could be not so great for the bulls, and I don't think that a rally would be, a sustainable rally would be in the cards. We could get a pop in the markets, but the VIX, look at this sloping downward trend on this full stochastic, already hitting oversold territory. Wins percentage has been in oversold territory on the VIX, and it's on the daily, but it's been trying to come out of it already. RSI is trying to turn up, and it looks like the VIX has found some support right between 27 to 2850. That's been a area of support. VIX is looking for a catalyst to take this next leg higher. I think we could get that this week. So pay close attention to these signs, folks. The VIX has found some support. It's been trading sideways pretty much for the past several days. If you look at this, look at the range that the VIX has been in. It's like it does not want to go. It is refusing to kind of drop below 25. The VIX futures is refusing. It's finding some support. It just needed catalyst, and the catalyst could be Fed minutes release. So today it's going to be something to pay close attention to. Don't play around with this market. The volatility is here, and if you trying to go long and be a long time bull, the markets, we are still in a bear market, and volatility is going to be at its extreme. You got to be ready to move when these moves happen. Again, my longer term target on the VIX is well above 40, and I think over the next week, especially after the Fed minutes release, or the next week or so, we could see the market start to unravel. Not only is the VIX showing us that the markets are ready to bounce, not only is the overall market showing you volatility is strong with these wild swings we've seen over the past day. Yesterday alone, I'm saying the market, the Dow was up at one point 600-700 points, and then it gave it all back. That is crazy volatility, folks. Crazy volatility. I'm not playing around in that market. I am just waiting, and I have a lot of short positions already set up. Been in those short positions for a while. Going to continue to hold those short positions and just let it, let the price action come to me. But I don't have my bull hat on. I just can't. I just refuse to put a bull hat on because it's nothing, no strong bullish points about this overall market. Trying to be a long-term bull is going to end up hurting yourself in the long run until this bear market is done. Now look what happened to crude, folks. A couple more things I want to point out to you guys though. But look what happened to crude oil, and this is one that made me really pay attention because the last time, and I'm gonna pull up a weekly chart. Do you folks know what happened? Last time crude did what it's doing now. Well, I'm gonna bring it to your remembrance. Let me see if I can. Let me go to a. All right, yes, go to a monthly chart. All right, this is really key. Crude, folks, it looks like it wants to pull back, and I mean pull back significantly. This is a monthly chart of crude. Look at what it's doing. Made it up to that 130 level. We've been unable to make it back up to that level since then. And then look at this. We're starting to roll over. We could come all the way back down here, folks, and test this 50-day moving average on the monthly chart. That's something to pay significant attention to. But the last time that happened, folks, so if we go back in time, August 2014, We are back at a level of resistance that we seen in August 2014. Last time we hit that level, crude sold off significantly. Look at that. Okay. Last time we hit these extreme levels back in 2008, crude sold off significantly. Okay. All right. Let me point something else out to you. Crude oil is well above the levels that it dropped from in 2020. Okay, so that was a level of of resistance. I mean, level resistance. We hit the 20-day, 50-day moving average, sold off and rallied back up. Crude oil hit resistance that has not seen since 2014. So what is the more likely scenario right now? It is highly likely that crude could continue to pull back and test the COVID highs of 2020, which would take crude oil right back down to the 50-day moving average, folks, all the way down here, just around $70 a barrel. That's something to pay attention to. And the last time crude sold off, the markets followed. Okay, so the last time crude sold off, look what happened. And in 2020, when crude sold off, hit that 50-day moving average, crude sold off. Oh. Crude sold off. And here, it's like we may be heading right back down again to possibly test the 50-day moving average. Okay. As a matter of fact, let me get rid of this. Move. Let's move this over. We're gonna try to duplicate this. Duplicate this drawing, move it right over here, and we could see the same type of, there we go. All right. So the same amount of sell-off or the same angle that we've seen here, look at that, I just moved it right over. Same type of setup is setting up right now, folks. Again, so the last time crude did what it's doing now, what happened to the markets? Let's see. S&P futures. Look what happened last time. Our markets did the same. 2020, when crude sold off, the market ended up selling off. Y'all see that? And look where we at now. We're in this downward trending channel, folks. We could definitely be heading for some super oversold levels on these monthly charts right now, right here, right now. That's the setup. That's the setup. You know what I'm saying? And what could spark it off? It could be Fed minutes release today. So I wanted to highlight that. So there's a catalyst in store for us to not really see a big rally at these Fed minutes. There's a catalyst. So I'm telling you all this just get you guys in a mindset to be prepared for whatever may happen at these Fed minutes release. Fed minutes release comes out at 2 p.m. Eastern Standard Time today, and it could be a lot of volatility within the day. You know what I'm saying, prior to that. But there is a setup, folks. There's a setup, because when crude started to sell off in 2020, the markets reacted the same way. If you look at the RSI and crude got oversold this year, not too long ago. If you look at the end of the oscillators and the full stochastics on this monthly chart, it's been heading down since November. So crude really, was giving us a telltale sign that it was rallying, but it's like it's trying to come to a peak. And we're starting to see the oscillator starting to confirm a pullback in crude. And I say a pullback because I still think crude has higher prices, I'm saying, over the next year or so, but I think it may be time for a pause. All right. Maybe time for a pause in crude. And with that pause in crude, it's going to definitely probably spill over to the markets. All right, so I wanted to highlight that and show you guys what to look out prepare for, and just what to be mindful of. And again, here's crude. Look at this daily chart of crude, folks. Just above its 200-day moving average on the daily, and it's like it's just setting up. It's a bear flag just setting up for some significant move to the downside. A couple more things I'll point out real quick before I end this video. If we look at the breadth of the market, overall breadth of the market, I tell you guys to be mindful and pay close attention to the SPXA 200R. It also gives you some advanced warning of what we could be in store for. So this is a daily chart of this tool, and I told you guys, if you look back at a monthly chart, you can see how severe this overall unraveling of the breadth of the market has been since May of 2021. We were as high as 97%. That means 97% of the S&P 500 companies trading above their 200-day moving average. Look where we at now. Look at this. I'm highlighting up here. Only about 0.18, 18% of S&P 500 companies are maintaining a level above their 200-day moving average. And we are close to my target of 0. So could we see a significant rally once we hit the 0? And that could be coming soon. That's a very possibility, but I don't think it would be the end of a bear market though. But I think sometime this summer we're going to see 0. I think we're going to hit the 0 point sometime this summer. It may be very, very soon. So I wanted to highlight that, how close we are to hitting the 0. We was getting close, getting very close over the past month, you know, but today may be a day that we could see some change. We could see a significant move down this level. Then we could see a significant bounce. Got to see what happens. But I think we're in a process of seeing this first leg of this bear market start to really unravel. And then, you know, that could be just the beginning of a nice little pop, and then prepare for the next leg down. So we have to see if that's what's unfolding right now. But the breadth of the market is extremely weak. And if we go back to this daily chart, look what's happening on the daily chart. And I even got moving averages here. Price action made an attempt to try to fill this gap. Percentages made an attempt to try to fill this gap. Let me go here. Try to fill this gap here. Made it back up to the level. Try to fill it just a little bit, and look what's happening. Big reversal. So big reversal is in store. We made it back up to the 20-day, and look what the RSI is doing, pointing straight down. So I told you guys before that when the breadth of the market shows you this action, normally the overall markets tend to follow eventually. That's the market breadth. And let's take a look at one more tool that shows you the current breadth of the overall market. And for you guys who are friends with me on Twitter, you know that I have, this is my Twitter feed, at God's Child Tim, and I have pinned at the front of my Twitter page the Wall Street Journal, New York Stock Exchange link to the new 52-week highs, new 52-week lows. And I looked at that this morning, and I want to point out, breadth of the market does not tell any lies, folks. It tells you what the overall markets want to do, even in the midst of volatility, even in the midst of big time reversals and big time bounces to the upside that can confuse people. If you come to this link, click on New York Stock Exchange first. What it's going to do, show you the new 52-week highs first. Look how many new 52-week highs were created yesterday. Only 4. Look how many new 52-week lows were created halfway down. 315. Now let's switch over to the NASDAQ. New 52-week highs created yesterday, and all of that big move back up to the upside, just 20. How many new 52-week lows? 493. Folks, these rallies can be very confusing, but if you look at the breadth of the market, it's telling you that the bears are in full control, and it's just waiting for the next big leg lower. All right, that's all I wanted to share with you guys on this morning. And as I see something else unfolding, I will bring it to your attention. Till next time, I'm signing off.